Nilesh Shah, MD at Kotak AMC, joining in on the phone line right now. Nilesh, morning. When you see a headline like this, you just wonder why not India. A, the India implications, and B, what would it take for India to actually reach that mark?
So let's look at some of the market gossips about how MSCI ignored China's poor corporate governance. In 2013, they had stopped people from taking money out of China. They had stopped people from selling on the downtick. They had restricted investors from selling stock in the company if their ownership was more than 1%. All this blatant, let's call it corporate misgovernance, were ignored by MSCI. We don't know how that happened, but there are some market rumors which I'm just bringing in front. Apparently, all those asset managers who approved or pushed MSCI to inclusion of Chinese local stocks in index have been given licenses to operate in China. This can't be just pure coincidence. Second, MSCI itself has got higher permission to operate in China, and local asset management companies have been encouraged to launch MSCI China index ETFs. So there is a business consideration. We don't know where the truth is, but clearly MSCI seems to be favoring China at the cost of other emerging markets. For example, in India, India's largest bank, HDFC Bank, is not part of MSCI India Index. And this is ostensibly because FIIs are not allowed to buy into HDFC Bank. They have ignored the fact that 74% of HDFC Bank is already owned by FIIs. On a daily basis, there is millions of dollars of turnover between FIIs on Indian exchange. They've also ignored the fact that every primary market raising done by HDFC Bank, FIIs have participated. So clearly, there seems to be little bit stepmotherly treatment to India and other emerging markets. And there is little bit own motherly treatment or godmotherly treatment to China. Be the case as it may be, we have to live with the consequences. And unfortunately for all other emerging markets, China is not only included at higher weightage in MSCI index for local shares, but they will also become part of bond index in April, and they will also become higher weightage country in Russell index.
Oh yeah, absolutely they will. But Nilesh, while we can't fight it out with the MSCI, how is it that we clean up our own house? What corrective actions can Indian companies take for us to be noticed by MSCI? Because this means billions of dollars pour into China.
So I think the problem is MSCI, and we have to engage with them. They can't have different rules for different countries. They have to have a standard rule. And since we don't have direct influence over MSCI, we need to go to investors and tell them that MSCI Emerging Market Index should not become MSCI China and other market index. We have to convince HDFC Bank investors that why are you not pushing MSCI to include HDFC Bank into the index? So the limitation remains with the, our ability to push investors so that we get fair share in MSCI Emerging Market Index. Today, our market cap is roughly about $2 trillion. China is roughly about $6 trillion. So ideally, their weight should be about 3 times India. In reality, with all this inclusion and changes, they could be probably almost 8 to 9 times higher than India when all these things get impacted. So we need to ensure that indexes are calculated in a fair manner. It doesn't favor a country. And the most important thing which we should remember that world is moving towards passive index. Today there are around $14 trillion which tracks indices. And MSCI is a predominant index. So we need to play for a longer term by ensuring that indexes are calculated in a fair manner, and it takes into account governance practices and behavior of regulators over a longer period of time.
Right, Nilesh, thanks very much for giving us that view. We now need MSCI to treat India at par with China and not turn it into an MSCI China. That's the word coming in from Nilesh Shah.